Hello, everybody, and welcome back to FAST CPA and Consultants. As always, here we are with our CPA, Fulton Abraham Sanchez. Good evening, Fulton. Welcome back to our Tax Talk series.
Thank you, Monica.
You're welcome. Today's topic is about tax deduction for real estate agents. So, Fulton, are we ready?
Yes.
Okay, so we have the first received question is, what can realtors write off on taxes?
For realtors, they have a special allowance from the IRS because they are professionals working in real estate. They are able to deduct from the activity, from the real estate income activity, the money that they receive for commissions. They're able to deduct all the regular expenses that pertain to that activity. Whenever there is a realtor giving their services to clients, the realtor will earn commissions whenever the property is closed, whenever the property is sold. But at the same time, the realtor will incur in expenses. These expenses are, for example, the realtor have to pay for a license, like a yearly license. They have to pay for continuing educations to keep up to date for the legality of the activity that they have. They have to pay rent if they have an office. They have to pay for specific activities that they have. For example, sometimes they are commissioned for being in charge of the management of certain properties. Whenever they have that activity, all these kind of activities that create income for him are subject to deduction. Whenever he takes a client for lunch, 50% of that bill will be deductible. Whenever they entertain a client for a specific project, they are courting a client or they are meeting a client for dinner or for lunch to deal about a specific topic, that is deductible. They can also deduct the miles when they drive to a specific project or specific property when they are showing the clients. In the last two cases, whenever they pay the bill to entertain a client, or whenever they drive to meet a client to show a property, it is a very good advice that to keep a journal of the places that the realtor drives to, with the objective of justify that in case the IRS is going to request the documentation, the proof of whom the realtor met and where the realtor met that person. In the other case, for entertaining a client, it is a good idea to keep a copy or to keep the originals of the bills and write the name. Then you have to write the name of the person whom you're entertaining. This is your last defense in case the IRS is going to audit you. It wants to, the IRS wants you to provide for proof of this and numbers that you are going to report in that activity. For the case of there is also one specific case. Whenever there is a person, a specific person who not necessarily needs to be a realtor, a real estate investor who is spending at least 750 hours in a year managing the property, those hours are also because of those hours, the activity, for example, the driving of the real estate investor from one property to another is deductible. Not the number of hours, that is not deductible. The number of hours is the qualification for the real estate investor to be able to deduct the miles that he or she drive from one property to another to take care of the affairs of their real estate activity. This is specifically for non-realtors, but there is that recourse that the IRS has given to non-realtors. For realtors, is different because realtors, they are professionals working as a base in real estate, or their activity is going around real estate. So any single expense that is related to the commission, or is related to the possibility or to the reality of selling a property, that will be able, or that will be subject for a deduction if there is income. The realtor must need to report income with the objective of deduct expenses. Again, if there is no income, it's better not to report expenses, because the IRS will, or you might risk an audit of the IRS.
Got it. And how much should the real estate agents put aside for taxes?
Real estate agents work as a self-employed. If they work by themselves, with, let's say, only by their personal name and with their license, they are self-employed. And let's say that the objective of not paying taxes, much taxes at the end of the year, is to pay taxes quarterly. So a good rule of thumb is to pay in every quarter 25% of the previous year tax payment that the realtor, the real estate professional, had in the previous year. So it's 25% of whatever the realtor paid of taxes to the IRS in the previous year. But this is not taking into consideration that the income of the realtor can increase in 1 year, in the next year. So if there is the expectation that the taxes are that the income is going to increase, in the same proportion that the taxes are increased, that same proportion need to be used to increase that 25% from the previous year. That's a rule of thumb. Now, if the realtor has a company, a professional association, an S corporation, or an LLC, it is also advisable that the realtor sets a percentage similar for real estate tax, for income tax payment. Because even though when there is a company, an LLC, there is no obligation to pay quarterly taxes, and when there is the obligation, when the realtor is a self-employed, and an LLC, that's an obligation. There is no such an obligation. At the end of the year, the earnings of the LLC are going to come to the individual income tax of the realtor, and at that point, the realtor is going to face a tax bill similar as the one that he will have faced if he were a self-employed individual. So either the realtor works as a self-employed, or he works in an LLC, or in a professional association that is an S corporation, an S corporation. It will be a good idea to save or to pay quarterly to the IRS 25% of the previous year taxes.
Understood. Thank you. And how does the IRS know if you sold your home?
This works the same as in the previous video when you sell a rental property. The key is the closing agent. The closing agent will always send a 1099 to the IRS reporting the sale. And when that 1099, the closing agent will note that this is your residential property. This is your primary home. And because this is your primary home, the IRS will take no action for that. If this is for rental property, then the IRS will take action and will require for you to pay the taxes over that gain.
Understood. And is real estate agent commission tax deductible?
Yes, but this is for only if you rent the property. If you do not rent the property, no expense is deductible. the commission for the real estate agent or the insurance or anything from that property will be deductible because the property is not producing income. The principle of deductibility, that something is deductible, is that the object, the asset, is producing income. That's why there is that recourse makes the expense deductible, because there is an asset that is producing income, and because the asset is producing income, the expense is deductible. If there's no income, there's no expense.
I see. And does selling a house count as income?
If this is your residential property, no, up to $500,000 for the gain of the property. This means that if you purchase your property $500,000 and you sell it to $1 million, and you are married filing jointly, 2 people, then there is no tax to pay for capital gains up to 20%. If you are one single individual and you purchased the property for 500 and you sold it for 1 million, you will be taxable for half of the gain. $250,000 will be taxable at capital gains if you, but you have to be, because you have kept the property for over a year, so it will be capital gain. But if you sell the property, if anything beyond that, if you purchase the property for 500 and you sell it and you sold it for 2 million, then the portion over $500,000 will be taxable for the gain of the property. The gain of the property is the purchase price plus improvement minus the sales of the property, the sales price of the property. That is the gain. So it's the purchase price minus the sales price of the property, and then you have to also include then the improvements of the property. But at that point, you have to have proof. That's a good idea. If you are doing rental and you think selling the property in the future, you keep the receipts, because the IRS is going to require that. Remember, but there is the only way that the income of a property doesn't count as and is not taxable, or the selling of a property doesn't count as an income, is that you live in the property. And the maximum gain of the sale is $500,000 if you are married filing jointly, 2 people, or you are, and if you are single, one person, it's only half. $200,000 is the maximum amount that you can not count as an income. After $250,000 over the gain, the purchase price, the sales price minus the purchase price, after $250,000, it will be taxable up to 20%.
I see, that's clear. And what expenses can you deduct when selling a home?
Whenever you are selling a home, you can deduct the commissions for the realtor, the taxes. But remember, this is based on that you are renting out the property. When you sell a house, you can deduct only when you are selling the property, but it's a property that you have it as rental or with rental, it's producing or has produced rental income. Your house, your residence doesn't count. You can deduct anything from there. The deductions, what expenses can be deducted when selling a home, this is considering only that the property is producing or has produced rental income. If the property has produced rental income, you can deduct the taxes that you paid at the closing. There are the stamps that you pay for the closing, the rental, the commission for the real estate, for the realtor that you pay. There are, for example, you can also deduct if you pay association fees and you have not paid the association fees of the rental. Those are liquidated at the rental. All those expenses are deductible. The commission of the realtor, the homeowners association, the taxes that you pay, for example, the taxes for real estate taxes to the county, if you have not paid that before the sale of the property, that will also be deductible. It will be deducted at the closing, and the commission for the realtor, as well as the taxes for the stamp. Stamp taxes are the taxes that are paid for recording the property with the county, with the state.
Understood. And here we have the last question, which is, how do I avoid paying taxes when I sell my house? So imagine here the person lives in the house.
Yes, the limiting your house to the gain of the property up to $500,000 for 2 people or $250,000 for 1 person. But remember, it is the purchase is sales price 100,000. Just to give it a 100,000. And then the purchase price is 50, you have a gain of 50. Let's put it in another perspective. $1 million, sales price $1 million. Purchase price 500. So my gain is $500,000. If I am married filing jointly reporting, I will pay 0 capital gains because the maximum amount is $500,000. If I am single, tough luck. I have to pay over $250,000. That is half because I am single. The tax up to 20% for capital gains.
Understood. Thank you. Thank you for the detailed and helpful information as always. And thank you everybody for joining us. You can check on our channel the different topics we have already explained. For example, Fulton mentioned the video we talked about FIRPTA. You can see our playlist, and then you will see all the other topics we have already discussed. Please be sure to subscribe to our channel before leaving so you can be notified when we publish a new video about taxes. Thank you, everybody. Thank you, Fulton, and see you everybody in the next video. Bye-bye.
Thank you, Monica. Bye.